Jerome Powell, he is at it again this week. What's up, everybody? Welcome back to another week, another episode with your one and only Kenny Simpson. This is the brief. All right. Man, we have a lot of stuff to cover, and we just got to get into it. We got to get into it. I have my notes here because there's way too much because I can't remember half this stuff, but I just need to know subject and we'll go on to it. But first and foremost, every week, what's going on with the inventory here in San Diego? 2708. We have finally reached a 2 and a 7 and an 08. Finally in the 2700 with 447 new, pending 488. Inventory, let's be honest, it just stinks. It stinks like the weather in San Diego this last weekend. That's what it stinks like. What else is going on out there? Let's talk about rates. Rates are just, we're not getting the love. We are not getting the love from anything at all. Rates are a little bit down from last week, which is good. I really have to keep my foot to the fire here. If inflation's dropping, we're seeing it. Rates are not coming down. Is it really, are rates going to come down with the job market? It seems that way. They want pain in that job market. So until then, I've been telling everybody, hey, I don't think rates are going to come down. I think they're staying elevated higher. Yes, a lot of people did not predict this, but we're here. We got to deal with it. So if you're refining or purchasing, this is the rate. Don't sit here and try to go, I'm going to wait till the next week or wait till this or wait till that. If you see a little bit of pullback, take advantage because it might not stay there. It's very volatile up and down. So rates, not much to say there, but I think it's going to determine what the job market does. And we need some pain in the job market, which we're not getting. So this is interesting. 78,121 total bank branches in the United States. That's how many bank branches are. Do you think that's too many? Do you really think we need that many? Is everybody even going into the branches? Like, I don't even really go into a branch unless there's like a major problem or you have to. So I just think we're going to see more and more branches of banks say, adios, we're out of here. And I think that's going to happen. So what are you using bank branches? I don't. Maybe our grandma and grandpa and our parents are using them, but I don't get it. I get people have to stop for cash deposits or get cash or deposit checks, or people just love to go in the branches. But US Bank is one of the top ones, shutting down 235 branches. And the big reason is if you don't, US Bank merged with Union Bank, which was a big bank here in California, which is a big lender here in California on the wholesale side, which they shut down, killing us on the jumbo product. So out of the 235 branches, 133 of those are in California. So I'm sure there'll be more consolidation with the First Republic branches and things like that with Chase. They don't need all these branches. And I think we're going to see more and more branches go away in the future. There's also what's big on the news too this week is there is a big bill going around because look, these guys, the politicians are not happy about this FHFA. I got that right? FHFA. Yeah. FHFA at Fannie, Freddie, that they propose all these new hits with pricing. Look, guys, their hits were already up. When we had the refi boom, their hits were down. Then they raised a bunch of hits for second home, for investment property, for cash out, for all these things. Now they're hitting them again. So I don't know. We got the one with the DTI. I think that's long gone. They're still going to give them a lot of hell for these hits. Look, they're already whacking us hard. I feel like everybody is just taking advantage of everybody. Yes. Calling out Fannie and Freddie, I feel like you're taking advantage. Why do we need these hits? Rates are already high. Spreads are already high. Consumers are already feeling it. Are we trying to cause more pain? You can't even do cash out refi for 1 year, Fannie and Freddie. They're doing everything they can, in my opinion, to stop and just not making it not exciting for people to go do a cash out refi or buy a place. They're just trying to really slow these things down, and that's why we're having the hits. Another interesting thing this week, before we get into too much, I want to give you a couple more fun stats this week. Flippers. Did you guys know what a flipper is? Usually they buy the property on market, off market from a wholesaler. They get in there really quick, like day one, tear everything out of that place, and within 90 days, 6 weeks, 9 weeks, 90 days, whatever you want to call it, maybe longer, depending on how good they are, they get in there and turn this whole property around, they put it back on the market, and they sell to you, the consumer, for a profit. And they do all the work that you don't want to do. They have the vendors, they have the contacts, they can do it quickly. And for the average homeowner with their job and their family and all this, it's a big pain in the ass. They're going to overpay. So they deliver deliver that to you. And obviously they mark up the property so they can make a profit and you're paying retail for that. Those flippers, they flipped 407,000 homes in 2022. So that was way up from the prior years of 2021 and 2022. According to a big fix and flip lender, their volume, they're one of the biggest fix and flip lenders out there. Their volume is down 40% for fix and flips. Few reasons. Number one, rates are super high. Number two, cost of materials and labor are really high. And also flippers are having values come back on future values. So what they do is they typically will buy a property and they might go get a appraisal on what they think it's going to be worth after they flip it. Those appraisals are coming in lower. They're either bailing on the hold flip, not buying it, or they're having to change some things around. So flippers are not as advantageous. But here in San Diego, look, you're getting an off-market deal and it's a good deal and you put the TLC into it and do your thing, you're going to make money. So I think flipping here is still great. If you can get a house for a decent price, somebody will pay you for doing all the work. And let's be honest, not everybody wants to do all the work. It is a big pain in the ass. It's a lot of work and time and effort. You can lose your money. You could get divorced from it. You can get in a fight. I'm not kidding. I'm just really being honest here. So this is a huge, huge week for the Fed. Let's talk about what we have this week as far as just data. We've got Fed's raising rates. We already know they're going to raise a quarter. If they don't, we would all be shocked. We've got new home sales, pending home sales, consumer confidence, PCE, GDP, jobless claims. My goodness, there's so much data going on this week and even next week too. There's a lot going on. We'll see what happens. We're expected for the Feds to hike. It's already built in the market. I don't think the 10-year rates will go up. Who knows? The Fed is not ready to pivot. And pivot could just mean stop hiking. Just stop. We're done. I know a lot of people think pivoting is he's going to start cutting rates. No, as you went back, I had a video that I think had 5 pivots in it. A lot of it's talking to hiking to stopping to talking. So right now, if they stop, we will be hearing a lot of blah, 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 talking about what is going on in the future, what's going on in the economy to what they're going to do. So once they pause and leave the rates here, that's still inflicting pain. That means they achieved where they want to land on the rates and they're going to keep that rate going forward until something breaks. What they're looking for most likely from what we're seeing, reading, analyzing, and all the experts is really, yes, they're looking at inflation and the consumer spending and all that stuff, but they're really looking at jobs. Jobs are too healthy. People have the money, they're spending, and they want to see some pain in the job market, which could be a couple million jobs lost. That's what we're looking for. Who knows? But Jerome Powell always keeps talking about jobs, jobs, jobs. What else is going on this week or in the news that's huge? It's Basel III. If you don't know what Basel is, go look it up. I'm not going to spend 10 minutes here talking about it. But basically what it was is after the consumer crash and all this craziness, right? After the Great Recession and all the craziness, housing market crash, they went into the banks and they said, you guys were not ready for a market crash, economic crash, housing crash. You were set up to fail. We've heard this too big to fail and all this stuff. So what they're doing is because we've had First Republic and SVB Bank collapse, it's obviously opened up everybody's eyes to, hey, we need to change things or tighten the bolt more. So they're going to go back in as they've done. They did this in 2010. They did it in 2017. And now in 2023, are they going to do something or is it going to get kicked down the road to 2024? They're going to go in there and tighten the screw a little bit and say, hey, banks, how's your balance sheet? Meaning how many loans you have out, how much cash you have. So a lot of banks right now, because they know this is coming, they're worried about this. They stopped lending. Yes, a lot of commercial banks have stopped lending. They're not lending. There is no loans. They're stacking cash. They're recalibrating their balance sheet. Remember, they can't go sell treasuries or things like that because they would sell it out of a 25% loss. So right now they just won't lend. So they're saying this could affect the mortgage market. It could definitely affect the jumbo market because they'll scrutinize more. So banks will make less jumbo mortgages. They cut back on LTVs. It won't be as aggressive and stuff like that, which is not good for the mortgage market and the jumbo market because Fannie and Freddie, they only go so high, right? 726, 500 here in San Diego, for example, is the conforming, and the high balance goes almost to $1 million, here throughout California. But think about it. There's a lot of loans here, $1 million, $2 million, $3 million, $4 million and up in California. Even in the 800,000, 900,000, there's jumbo products we can go there. Some people want ARMs or interest only. Those are going to be tougher. They're going to make it tougher on the banks. I mean, I get it. But what are you going to do? What are you going to do? I don't know. But what else is happening this week? Oh, also, let me make a quick note on that banking debacle. This also, commercial loans are being heavily affected, and it's going to really, depending on how bad commercial loans unwind or come due or what the problem is there is going to be tightening with commercial loans and all that stuff as well. So that's going to affect I think it will affect the commercial market much more than the residential market, because remember, we have Fannie and Freddie, FHA, VA, USDA, non-QM. So we have a lot of products, and commercial does heavily rely on banks. Yes, they have Fannie and Freddie for apartment lending, and they have, these institutions too that also lend. But, banks, the regional banks, remember, do 60, 70% of the lending for commercial. So it will be a problem. But also all those crashers out there, all you doom and gloomers that have been saying the market's going to crash forever. And look, I was a little bit on their camp too, thinking like, is things going to crash? Things going to pull back? Like, what's going to happen? Because honestly, we're in uncharted territories. But what I've really gotten good at is thanks to my friend Logan over at Housing Wire. If you're not following him, follow Logan. But he has really taught all of us, because he's done it through month after month, week after week, year after year, is just analyzing the data, sticking to the data, and just basically following that. Don't listen to the YouTubers or the bloggers or the people on CNBC or the guy from Goldman Sachs that, San Diego's going to crash. It doesn't mean something can't happen. But today, right now, as we sit here, housing prices are starting to go up. So in 2022, we started seeing a decline. We went from a seller's market to a buyer's market. Then rates, remember, dropped at the beginning of January. Then we went from a buyer's market to a stable, almost buyers and sellers. Now we've moved back into a seller's market. I'm not saying every market. I'm just saying the market here in San Diego, for example, we are in. But a lot of markets have basically gone back to seller's markets where people are overpaying for the price property. Yes, rates are where they're at. Builders are winning here too. But the point is like Logan has watched this data and studied it. And now that we know, instead of all the hype and all the fun, the drama over data, we're really starting to look at, I've really been the last year or two study this data and come to realize that the data doesn't make sense for a housing crash. The data doesn't make sense for a correction. The data doesn't even make sense to get inventory, because everybody thinks, well, when rates go lower, we're going to get all this inventory. Are we? Are you sure? Maybe we'll get some, but how low are rates going to go? So if the conventional 30-year fix goes to 5%, remember, there's almost 75% of people have a 4% or less. So what you're telling me is if rates go to 5, that person has a 4 or 3, or maybe 2, is willing to sell their house, pay more for a new house, so pay higher taxes, insurance, and a mortgage payment and rate than they are now. Sure, maybe there's some, but there's not going to be gazillion and millions of them, right? Not enough. So the only thing that we could really see inventory kick up would be a scenario where the economy goes really, really bad. People lose millions and millions and millions of jobs. Shit hits the fan, and people have to sell because they need to get equity. They need to basically flight for cash. You get that money in there. Yes, there's going to be people that might have to sell an investor property or one that's not doing well or things like that, right? But we're not talking enough. Even if, like we said before, even if you listed every VRBO on the market, and I know some of these are heavily concentrated in certain areas, so certain areas would probably just kill that market. But if you put them all on the market and they're all equally spread out throughout the US, 1.4 million units, you would not necessarily get a housing crash. You get a lot of inventory. You get a lot of buyers going, oh my gosh, there's so much more inventory, and you would push a lot of people off the sidelines. That would be great. But remember, when that inventory is bought up, it's over, it's gone. So we're not getting this 1.4 coming over and over again to be a one-time thing. And so that would get swallowed up. I know it's not just evenly spread out. There's certain areas that are like Joshua Tree that have so many, or Palm Springs or places like that where it could get crushed. But I don't think everybody in Palm Springs or Palm Desert or Joshua Tree is going to sell their vacation rental tomorrow. Last but not least for this week is really, honestly, we have to see what goes on with all this craziness, with all the economic data. There's so much uncertainty. So many people are wrong. We're still talking about a recession. We're talking about a soft landing. More CEOs and economist advisors and things like that, they are thinking more of a no recession, a soft landing. The hard recession's kind of gone away. That's because job market's still strong. People are still spending. But let's be honest, guys, we're running out of cash by September. Credit cards are all-time high. I just don't think people are going to keep spending up this much. So I think eventually we are going to have a consumer slowdown, not a crash slowdown, because they're just not going to keep consuming at this rate, because we came out of COVID, and I get it. Everybody wanted experience. Everybody wanted to go on a trip. Everybody wanted to get on a plane. Everybody get a motel. Everybody get a VRBO. Needs to go buy a new pair of shoes, pants, shirt, go out to eat, go see their friends. The whole list. We all did it. But eventually we're going to be like, cool, I did all that stuff. I'm hungover. I need to take a break. I need to save money. And that's what's going to happen when people run through their savings. Maybe after this summer, we are going to have some slow back, and maybe that will shake up and loosen up jobs where people are going to get laid off, maybe in the hotel space or things like that, right? Hospitality space, because there's so many people that are doing stuff there, and it's going to go away. But who knows? But until next week, we'll see what the Fed says. Next week has a lot of data too. It'll determine where we stand. I don't see rates coming down. I don't see inflation doing much. We're going to keep slowly coming down. I don't see the inventory going up. So if you want to buy a property and you're waiting for rates to come down, just buy the property, lock it in, and you got to deal with it later. If you're waiting to refinance and chase rates and try to hit the specific number, I don't think you're going to get there. I think you just need to basically live with what you got and refi it and hope to plan to refi as soon as possible later. Thanks for watching. Have a great week. We'll see you next time.